and to create that 15% return, doubling money every 5 years, that it takes a lot of patience. Money making is, in my opinion, is a patient process.
Hello and welcome to Gaining Conversations, a podcast about personal finance. I'm your host Ravikant, co-founder of Gaining Ground Investment Services. In Gaining Conversations, I talk to financial experts about personal finance and how they think about investing. If you're interested in meeting financial life goals and achieving financial freedom, Gaining Conversations is the perfect podcast for you. My guest today is Madanagopal Ramu. Madan is the head of equities and fund manager at Sundaram Alternates. He has over 18 years of experience in the financial markets and oversees about 3,500 crores across the portfolio management schemes and the AIF. He comes with a strong academic background. He's a qualified cost accountant and has a management degree from BIM Trichy. He is known for his in-depth understanding of equity markets, strategic fund management, and ability to identify secular investment opportunities. His strategies have consistently delivered strong performance, earning recognition in the industry. In today's episode of Gaining Conversations, Madan and I talk about how investors should think about alternative investments and how he is constructing his PMS portfolios at Sundaram Alternates. I have seen myself his investment style over the past many years, and talking to him and getting some insights is a privilege today. Without further ado, let's talk to Madan and understand how he has built his investment framework. Hi, Madan.
Hi Ravi.
It's great to have you here in Gaining Conversations. Thank you so much.
Thanks for having me in this conversation.
I'm glad we have the opportunity to do this. Before we start talking about some serious heavy stuff, let's have a little background for you. You grew up in Chennai, you graduated from Trichy, then you've done cost accounting and then management degree. What was your initial career plan?
Yeah, right from a period somewhere closer to when I was doing my senior secondary standard 12th, as we say in Tamil Nadu. I was inspired looking at some of my friends who started investing in stock market then. So at that point of time, looking at an economic times was like looking at unknown for me. But something kept fueling into that fire time and again. So when I finished my MBA degree, first job was not in stock market.
I see.
I joined Power Finance Corporation in Delhi.
Interesting.
But 1 year down the line, I could not. I wanted to move into the market. So I took a conscious decision to move into some smaller firm. I ended up with Centrum Broking.
Okay.
And then moved into it. And so since then I've been in the market. So what really interests me to be in this in this profession is the financial freedom and the wisdom that it offers to an individual. I think it is unparalleled, and not many careers in our life can provide both money and knowledge simultaneously. That something keeps motivating.
I completely agree. Once you start tracking this whole markets and understanding, it's a different sphere of knowledge.
Correct.
So you after your first job, and then you started with Centrum, and then you got into Sundaram Mutual Fund, right, as a fund manager.
Yes.
Right. And what was after that? So how did you get into alternates?
Sure. See, when I was with Sundaram Mutual Fund, and I started as an analyst there, I then moved to head research and then started managing few funds along with the CIO then. So during that period, what was always interesting to me was identifying certain really good businesses from a long-term perspective. And there are certain businesses in the consumption space and banking space which I used to like when I was head of research. And when I moved into alternates, what alternates provides you is you don't need to really look at the benchmark. And generally, if you look at Nifty, most of the matured sectors and stocks get into Nifty. By then, it is well identified by the market.
Correct.
So the real crux of making money happens when you are identifying a long-term growth opportunity stock at an early stage. Alternates provide you that opportunity because you are not investing looking at the benchmark. You are investing purely based on the outcome of the business that you are looking into. and what growth that business can throw. So, in a nutshell, I think alternates provides you with that opportunity to kind of explore more opportunities and select and create a high conviction portfolio for you as well as for the investors, which can create a good returns in the long term for you.
Very fascinating to learn about alternatives. So let's start with some basics. So what is the appeal of alternatives? Why should investors look at investing in a PMS or AIF? Whatever schemes you run. What is that appeal?
So, for example, as I was telling you, like if you have probably the other opportunity that you have is to invest into established Nifty, which is diversified 50 stocks, or invest in some other diversified funds, which are plenty in the market right now. The problem that I see with investing with the index, particularly Nifty indexes, most of these sectors are almost like in a maturity stage. In every economy, when it is in a growing phase, in different periods, different sectors grow at a there are a set of sectors which are growing fast, there are sectors which are growing slow, there are sectors which are not growing at all.
Right.
Nifty predominantly has a mix of all the three sectors and very less of the fast growing sectors.
Okay.
So what alternates provide you is just don't look at the Nifty. And even if you take BSE 500, 70% is Nifty, right? So therefore, the majority of the money that if you want to make in the long term and compound your money by at least 15% over a very long period of time, then I think you need to go beyond benchmark stocks and invest into it. That's what alternative can provide to you, that we don't need to invest into these benchmark stocks which are well researched, well identified, very less left on the table, and go and search for ideas beyond the benchmark and then give a very high allocation. And there is no restriction on you, there is no force on you to diversify your fund. And in the long term, diversification, in my opinion, brings risk. In the short term, when the markets are volatile, diversification is a good tool. In the long term, majority of the money you'll make in your life comes from 5-6 stocks that you identify. And if you don't have a right allocation into those stocks, then it's not a very good justification you have done on your research itself. These are the positive things that alternate brings on table to you.
That's really interesting. So you mean to say that investing through having alternates in your portfolio improves the quality of your portfolio, and it also improves the returns. And when it comes to risk reward, I think you're optimizing returns while minimizing the risk.
Correct.
And also have high conviction ideas in the portfolio.
Exactly.
Excellent. So we'll move on now. What do you think? How long should investors stay invested in a PMS or AIF?
Sure. How long? I think the best way to explain how long to invest in equity markets is if you understand this simple mathematical concept called compounding and the effect of compounding in a simple term, then I don't think we need to educate any investor how long he needs to invest into. Like, for example, I give this statement. I started my career with markets at 30. Probably I had 40 years in front of me where I can use my brain to select stocks. So 40 years is a long period. If I can double my money every 5 years, in a 40-year time period, I have 8 blocks of 5 years.
Correct.
2 power 8. Every 5 years, if I am doubling, it is 2 power 8. 2 power 8 is 256. Even if I had put 1 crore of money when I was 30 into the market, and I just managed to double my money every 5 years, which is a 15% compounding growth rate, I would have made that 1 crore to 256 crores.
Wow.
And that's a serious money.
Absolutely.
So now, if somebody wants to invest in the market for 5 years, they are looking to just double the money. Somebody looking to invest into the market for 10 years, they are looking at almost like 4 times return. Now this 4 is becoming 8, 16, 32, and 64, 128, and 256.
Yeah.
And imagine every 5 year you give additionally to the money, the amount of money that it is going to generate on an absolute basis on the initial sum that you have invested. To me, an investor in equity market should invest forever, create huge wealth. Probably whenever he needs some bit of money for his meeting personal goals, yes, obviously you can take it out. But I think a lot of discussion is happening in the market on market cycles, volatility, fund manager style, all this stuff. I think a reasonable amount of judgment on the fund manager style and the space to be, that's all, it's enough. I think in the long term, if you have left the money, it is going to provide you a serious compounding effect on your wealth. For the number that I said, I don't think you will retire as a poor man.
True.
So I think that's what, when you ask me the first question, what motivates you to come into the market? When I did this in the math, I don't think you don't really need any other motivation in life.
Yeah, I completely agree with you. I think once we understand the magic of compounding and we orient our mindset towards investing for long term, I think
Everything changes.
that's a good combination to create really good wealth.
Yes.
So let's get let's understand what strategies you manage and what is your style of investing.
So I manage 3 funds called, one is Secular Opportunities Portfolio called CSOP. Second is Emerging Leaders Fund, which is predominantly invested into mid-cap called SELF. A slight variation to CSOP with a little bit more aggressive positioning in the market called Voyager. These are the 3 major portfolios that we manage. We manage close to around 3,500 crore across 3 portfolios. Roughly 1,000 to 1,200 crore in each of the portfolios is what we manage. Spread across both the PMS as well as the AF platform. Now, if I look at the style that I approach predominantly is, as I told you, we look to identify sectors which are part of the fast growing part of the economy. So as I told you, any economy in a growth phase, there are sectors which are growing fast, which are sectors which are growing slow, there are sectors which are not growing. We don't want to invest into sectors which are not growing. We might invest into sectors which are growing slow, but if there is a value opportunity in that sector. But again, that is a small portion of the portfolio. The predominant amount of money is invested into companies which are part of the fast growing sectors in the economy. And the reason is, these are generally out of the benchmark and are not well identified by the market. So your research skill can be used to identify at early stage, and you benefit 2 ways. First is, one, it gets identified by the market. Later, it gets into the indexes. When the indexes, it gets added, lot of money chases them, flows comes. Eventually, when it gets added to something like an MSCI index, foreign money also chases. When foreign money chases, the cost of capital is low, therefore the valuation gets re-rated generally. So, if the benefit of identifying some good quality businesses when they are early in their stage of growth, then you benefit not only from the earnings growth, which will be much higher than the overall market, but also you benefit from the re-rating that it provides, because it's getting into the ambit of larger funds and the larger indexes. You benefit from both. My sense is, in the last 6 years, since I have been managing this portfolio, we had the privilege of investing into some 6 stocks, and they would have created a large part of the alpha that we created for the investors. So that is the approach that we take. That is part of 60% of the portfolio. And again, I said, remaining 40% we invest, 20% of that 40% we invest into certain sectors which are in the limelight this year. We call this as a dark horse theory, that they are not great businesses in the long term, but for a year or 2, the company is benefiting from all the investment they made in the last, say, 4-5 years. Like what happened with the Reliance Industries during COVID, what happened with Bharti Airtel for the last 2-3 years, what happened with Bajaj Auto last year, what happened with ITC in 2022 after so many years of underperformance. You cannot invest into ITC or Bajaj Auto from a long-term perspective, or even Reliance Industry from a long-term perspective, if you want to make serious money. But there are periods when they can throw good returns to you because they are monetizing all their investments in that period. So that forms another 20%. Remaining 20%, we always look to identify small caps which are not so well researched, but unique ideas, niche companies doing very well in a small sector, which is not a large sector, but it's a very small sector. This company is doing well in that sector, and the sector is also doing well at that point of time. Then I think they provide a reasonable amount of return to you. By bucketing into these 3 aspects, one is playing to your core competence of identifying high growth quality stocks. Second is also having some value picks or turnaround stories with the 20%, and also adding some 4-5 stocks of small caps which are not identified by the market. That in my opinion, it provides a very sustainable sort of an return to the investors in the long term, and it can create a reasonable alpha over the Nifty, in our opinion, in the long term.
So I like the term, dark horse theories. So any such serious money you made in the last few years, one or two examples, it'll help us.
So dark horse theory starts with this, right? That it is not, the business is not as bad as what you thought.
So market perception
is as bad.
Correct.
That's what happened with ITC for that particular year.
Okay.
Last 10 years ITC has not seen any growth, but that year it happened. So with me, what happened last year is we played certain Bajaj Auto, because we thought that Bajaj Auto, generally two-wheeler is not a fast-growing sector, and neither these. I think two-wheeler volume is not even touched 2019 in 24 also. But Bajaj Auto had a period where its three-wheeler volumes recovered. It had new launches in its core two-wheeler premium segment, Pulsar segment. All this put together led to a good earnings recovery for that company. So the stock was available at a significant discount to other auto companies in the market. So this you can call it is not as bad as what the street thought, and there is an earnings upgrade that is possible. So you play into it. Similarly, I think we did one more company where it was trading at a significantly cheaper valuation. It's called Dynamic Cables. It is in the same space as Polycab, but was available at a 50% discount to Polycab. Nobody identified it. Then again we played and bought that company much early. This can be combined with dark horse and the small cap unidentified stock sort of an approach, you can say. But again, there we made good money last year. So in a year, I think 3-4 good dark horse, if you can identify, I think you are home.
Excellent. But so you mentioned about a cable company, and what was your initial interest in the sectors? What you started as, when you started working with the company and then Centrum Broking, and how are you leveraging that current, market themes?
Sure. Very important. I think I started my career, as I told you, with Power Finance Corporation. So when I joined markets, the Centrum thought that I am very good in power and capital goods, so I covered those sectors. But those entire 10 years from 2010 to 2020 was not a great period for infrastructure at all. Not much money was made except for some blips here and there during 2013-14.
Was that because of government spending?
Yeah, broadly, we will come to it. I think how investors see infrastructure and all, we will cover it. But broadly, long period, I think infrastructure, given the way cycles play out there, it's a long cycle, right? It takes a lot of time before it recovers. So it went through a down cycle. And a lot of the money is made in these sectors by playing the early stage of the cycle, not at the later stage of the cycle. So in 2010, most of these sectors have been well played, and money has been already made. And then from there, we started struggling. The power sector and all started struggling, right? So covering those sectors was a big pain in those periods. I used to jokingly say, if not for Volta's AC and Crompton Greaves consumer durable business, many of the capital goods analysts would have lost their job.
Okay.
But then everything changed so even in 13-14 we made money by that pocket by investing into certain stocks. But I think 22, 23, 24 was a great period for recovery of many of these sectors. Typically they do well. But what has happened in power sector, which I have been tracking for so many years, not making money, underinvestment started in the last 4-5 years. And power sector generally take almost 6-7 years for your projects to come. So now we are in a phase where power sector, which I learned for so many years, is in a good space. One is there is no competition here now, because there was a lot of competition then. Chinese were there, Koreans were there, and India was freely importing from China and Korea. Right now there is a restriction on your import in these segments. There are only three players who manufacture many of these products, high-end products like Siemens, Hitachi, and then GETD. These are the three companies which do many of these products. And then even BHL today don't suffer at the hands of Chinese, because in the last cycle Chinese competition was very heavy in this space. So competition has changed. Underinvestment is now turning into an investment phase. What good can happen? So the years of researching capital goods and the power sector, we benefited in the last 2 years by investing into the right stocks in those sectors, I would say. But post my period as an analyst, I started focusing on banking and particularly NBFC and consumer discretionary. These are structural stories. While power and all this is like a 2-3 year story, I think banking in India, NBFCs in India, and then consumer discretionary, even recently e-commerce as a space, these are structural stories. I think we have next decade, you can keep on identifying ideas within this space. And that's an area I spend a lot of time researching, spending time understanding them. A lot of dope of that comes from reading what happened with similar companies in US and how they created value in the long term. And keep reading about it. I think you create a long term sense on how to invest in these stocks. Even these stocks go through periods of correction, but I think in a decade, if you can get many ideas which can grow for 4-5 years continuously in these sectors.
That's really fascinating. So you manage about 3,500 crores AUM, which is no small feat. What do you find most challenging and rewarding about this responsibility? I'm sure, when you joined, the AUM was...
So when I joined, most of these 3 portfolios that I mentioned were having close to 200 crore each.
Okay. That was 6 years ago?
That was 6 years ago.
Okay.
And we made it 4 or 5 times each of them in the last 6 years.
Excellent.
So you asked about what are the major challenges you face. I think investor expectations, managing it is the major challenge, I would say. Because when markets go through cycles, investors' expectations change. Their assessment of risk changes.
Correct.
Just before COVID, the 5-year rolling return of Nifty is in single digit. In mid and small cap, it was even closer to mid single digit. So the risk perception of the market was completely different. It was too much of pessimism, which was unwarranted, which we tried to correct. Then came COVID, and then money started flowing into the market, and all those weak companies and weak businesses started getting rewarded in the market. And now people are expecting that you have to take high risk, which also not warranted. So I think risk perception changes in the market in the eyes of investor, and guiding them and holding them during those phases are the most important part of a fund manager or any AMC, in my opinion, because investors tend to get carried away with the momentum. And it is a responsibility of the advisors as well as the AMCs to guide them during those phases. Right now, what we see is another period of change. Like in 6 years, first 3 years for me was a sideways market. We did really well in that period. Then first leg of bull market also we did well. But the remaining 2 years were challenging because the businesses which we generally avoid were the businesses which were recovering very strongly, but without any substance, without much of substance. Then now the market has seen peak of the valuations, money is being pulled out by FIIs, the fear is starting to build up. I'm sure that in a year's time, market is going to get into a very pessimistic sort of a framework. Again, you have to handle the investors to guide them, saying that if a country is growing at 6% and India has come out of so many issues in the past, India will find a way to come out of the current slowdown also. And it has many positive demographic and democracy and the market cap to GDP and very well laid out policy initiatives right now to protect the domestic industry. I think there are a lot of positives, and with that the country can recover. So never bet against the country also, but also there are certain challenges which are there for the country, which we will slowly come out of it. So keep that framework very tight and then accordingly select companies. I think that's a very important aspect which we need to continuously engage with the investors to make them understand what we are up to, and to create that 15% return, doubling money every 5 years. That it takes a lot of patience. Money making is, in my opinion, is a patient process. You have to be building your honeybee like a bee, not trying to attack it like a tiger.
I agree with you. So on that context, when you're talking about how investors behave and all that, As a fund manager, how do you balance your styles of investing or risk management? How do you balance this and navigate?
Yeah, our learning, and I think currently what we do with is, as I told you, the three buckets of investment. We don't think in only one dimension. We think in three dimensions because market keep providing opportunities across various buckets. Never say no for any of the bucket. But what is our core competency is investing into high quality growth stocks that we allocate majority of the money, but we also feel that you need to provide space for as I told in the initial part of the discussion, there will be a period where you need to play momentum to some extent in your portfolio. There is a period where you need to play opportunities a little bit more. There is a need, you have to go defensive also in the market. So the best learning for us is that your role is to make returns to the investors and achieve a target of 15% CAGR return minimum, in my opinion. For that, I think what is required is you have a core portfolio, but also play around other buckets of opportunities in the market so that you be much more consistent in the market. I think any fund manager who has gone too much into a particular style of investment and avoiding all other opportunities in the market, I think they have gone through much more volatility than what we have in the last 10 12 years of existence. In our opinion, that's the biggest learning for us.
Over the last 18 years of your market experience, what has been the most significant change in the Indian equity landscape? What have you been observing?
I think I think first point is this. I'll again reiterate this point. This is very similar to what US veteran investors in US have mentioned always about US. Never bet against this country. This country would have seen war. This country would have seen the recession. The country would have seen all sorts of things, right? But the country always comes back. And I think very similar properties are there with India. The way the equity market is evolving in India, because India is a very strong capitalist market, right? From an equity perspective, open market, the investment opportunities and the way you invest is much more easier in India in the market. And the savings are getting into the market, which is a very big change that has happened, right? I think even I underestimated the amount of household savings can come into the market. And last 2 years was a eye opener for us. So looking into future in the market, I think this one factor, it's always cyclical. Let's not assume that it is structural, that money will keep on coming from households. They have seen money made in the last 2 years, so they are coming in a lot. When they don't make money for a year or so, they might relook at it. But my sense is, I think, keep these both. Never bet against the country. There is a growth of around 6% is possible in this country. If 6% growth is there a money to make 12 to 15% in the market? Yes. If that is the case, whether a lot of savings can come into the market? Yes. It can be cyclical, but every time when the cycle matures, you will see a large amount of money coming into this market, which together, if you put together, then what is the risk you are playing in equity market? This seems to be the safest bet, but only caveat is you need to be at least for 5 to 10 years in this market.
True.
Not try to be for 1 year, 2 year story. Then I think equity is actually the less risky product than what it is being thought the moment we put these two aspects in our mind.
So last 3-4 years, if you look at, there has been a good inclination from savings to investing. Okay, and people have seen good returns when the recent investors who have invested. Assuming that, and how do you see 2025 playing out? With your
so I think an investor. So there was one investor, not the investor actually. It is a sales distributor whom I met 2-3 months back when I talked to him about 15% return, long term, doubling money. He was asking me like, what will be the compounding effect if we make money at 40%? So 40% return. Then I had to correct him saying, I think you are taking a big risk by assuming that market in the long term can keep delivering you a 40% CAGR return. First thing is to tell them that in the long term, equity market taking a reasonable risk can provide you 15%. With bit of our efforts to play some bit of the small caps, opportunistic ideas and all, I think we can target something like a 17-18% return to the investors. If your rolling return from wherever you started is higher than 20%, keep it in mind, at some point it will normalize for you. Whatever you try to do, be prepared for it. Don't try to move around styles or funds because you think that something else is working. Give enough. Even if you are a small cap investor, if you had exited in 2020, you have made the biggest mistake. Just 2 years down the line, your average CAGR return, rolling return in small caps would have looked much better. So if you are invested, be invested from a little long-term perspective. 2025, it depends on which segment of the market you are investing. If we have made good money in mid and small cap, right? Mid and small cap will continue to deliver good returns to you, but if you have to be choosy in mid and small cap. But if you are investing into an understock portfolio in mid and small cap, the tail will start hurting you for the next 2-3 years. This is the first point. So if you are in mid and small cap, you have to be choosy about which stocks you invest, trying to make return out of an understock portfolio, which helped you in the last 2 years because the tail was benefiting you. The reverse will happen in the next 2-3 years. We have not yet seen redemption. When redemption comes, the pain can be severe also. Just rewind to 2018-19, you will understand what I'm saying. Mid and small caps together lost 20-25% in that period. So you can avoid it, but you can also not avoid mid and small cap completely, because the much of your return is also going to come from those 5-6 ideas in mid and small cap. So for us, mid and small cap is still important, but we are only referring to those 5-6 ideas in each of them. And the other side is, people ask, so should we go to large caps? You can. Only thing is, large caps will provide you that 8-10% return in that space. So cap curve basis, people have to rethink on what they are doing. That is very important for the investors who are in diversified portfolios. But if you are invested with alternatives, I think that risk is well taken and understood and appreciated and managed by the fund manager himself, because he is not going to invest into 100 stocks, right? He is going to invest into 20-25 stocks. He needs 5-6 ideas in each of the cap curves. So I think what is important is that from a style of investment, it is important to move away from diversified portfolios to concentrated portfolios and be with the quality investor, quality fund manager, right, and move away from slightly high beta fund managers. So that's something which you need to rethink about.
Right. So my next question is, what are some of the bigger challenges and misconceptions about investing in alternatives?
Yeah, one, I think the biggest misconception about alternative is people. One is that I think a lot of discussion happens on the tax side for the investors. Alternatives will provide you that additional return, if not 1 or 2 years in the long term. Fact that we have beaten the benchmark by almost 6% since inception, and even last 6 years we have beaten the benchmark by almost 5-6% since the time I started managing, shows that with so many other fund managers struggling to beat the index, there is a reasonable amount of alpha to be made. And this I'm talking after a period where passives have done really well. It can really change in the next 2-3 years, and our alpha can look much better also. Next 2-3 years, rolling alpha.
Be more selective.
If you are more selective. This has to be understood. And for this higher return, there is a bit of tax that you have to pay. People tend to believe that mutual funds you don't pay until you sell the units. But when mutual funds go through a correction period, people sell. And when they sell and they pay a good amount of tax. So there is a misconception that every year when the tax returns are filed, that we are paying a little bit more. While as a fund manager, we try to avoid tax. We don't want the investors to pay tax. But I think for the extra return, tax is a part and parcel of this business. Second misconception is, I think people tend to get carried away with their perception of risk, as I told you. They conceive risk in a different way during a bear market, and in a bull market they completely turn the other side of the risk taking appetite. So being balanced in that is also very important in my opinion. These are the few things that I keep on handling with the investors whenever I meet them.
Okay. So, what advice would you give to first-time investors looking to enter Indian equities?
I think enter as early as possible in your life. That's the first thing that you can do for yourself. As I explained to you, the effect of compounding, every 5 years you allocate more. Like I started in 30s, so I think I was late by 10 years.
Okay.
Just put this 10 years in front of me,
Yeah.
and I gave you a mathematics of 2 power 8, 256, 1 crore becoming 256 crore. Another 5 years, you can do the math and see.
I can relate. I started at 28. So my first SIP was started. So
Yeah.
I can imagine that compounding, I can actually feel that really worked well.
And the absolute amount of money that will add to you every 5 years is a phenomenal number. So start early. Investment, that's the first thing I would say. And money making is a patient process, and it's an outcome of knowledge that you build. You have to read a lot. There is no escape mechanism. I always speak about this. Charlie Munger reads. He says he reads 500 pages even when he was 80s and 90s also. I don't think we all read 500 pages in a day. I think at least 100, 200 pages is a must. Unless you create wisdom, thoughts on several sectors, how to make money. I don't think you just need to read only about sectors here. You can read about, as these veterans have always said, a lot of your ability to judge the business, judge the promoters, comes from not only reading the industry-related books, but also reading autobiographies, wherein you can understand the leadership styles, and you can relate it to the promoters of the companies that you are investing into. And I think the reading a lot is a very important aspect. And a successful fund manager gains by compounding his money. Successful person in life also gains by compounding the amount of time that he invests in his reading, in his personal relations with his family, and third, by compounding his money by investing into market. Right. All three are compound interest. Your the amount of learning that you do, amount of time you spend with your personal relationships, and the amount of money and the time you give for your money to multiply. All three are function of compound interest, in my opinion.
Excellent, golden words. I would agree.
This was said by Ravikant, Naval Ravikant, in his book Almanak.
Okay.
The almanac of Naval Ravikant.
It's interesting, and that's a good recommendation.
Sure.
Useful for my audience. On the other side, somebody who's a seasoned investor. We talked about first-time investors, but for a seasoned investors, what would you suggest to maximize returns in the current market? People who want to come with the long term, but they want to look at alternates.
I think in the long term, invest into the early stage sectors that you understand very well, and identify companies within those sectors, because if you have got the right company within a sector that you understand the most, your conviction is going to be very high. If your conviction is very high, your capital allocation is going to be very high. Therefore, even if for a 15% return, and CAGR return of say for 5 years, you want double money. If you have 3-4 ideas which are doubling money in 3 years time period, it helps you a lot, right? So that comes from your high conviction bet on certain sectors that you understand well, and the stocks within those sectors. So I think a seasoned investor should create a thought process on certain sectors that he is very comfortable with, and the fund manager associate with the fund manager that he is investing into, and also look for, as I said, that not too much orientation into a particular style, and also create space for other styles of investments also. Right. And keep a balanced bucketing sort of an approach in your investment. Not put everything in a single basket. But the other extreme of this is don't over diversify.
Yeah.
I think beyond 25 stocks, I think conviction starts diluting and diversification becomes a risk.
So I have one important question. So India has done a lot of things over the last 10 years, be it building infrastructure, roads, railways, airports, your metros, all this is happening. What do you think? I just want to ask you, what excites you most about the future of Indian equity markets?
instead of saying exciting, what is the opportunity in front of India? In front of India, there is an opportunity to what we missed for so many years, that we wanted to become a manufacturing based economy. For a long period, we have depended on agriculture. Labor force dependent on agriculture is still very high in India. Any successful country which has moved from a mid-income to a very high income or very high per capita income, it was possible only if we have shifted to a manufacturing based economy. I think there's a big opportunity for us. We have a large amount of labor force, which working age labor force. China is already getting aged. We are going to have another 30 years in front of us where we will still have a growth in the working age population for us. These are very important 30 years for 25 to 30 years for us, and this is a big opportunity. And I think if manufacturing can be supported, and domestic manufacturing can be policy can support the domestic manufacturing, make it compulsory for procuring from India, but also in the same period don't become complacent, and the moment you start protecting the domestic industry, you also run the risk of inflating the price of goods and services. So ensuring enough competition within the country, but also ensuring that technology keeps flowing from outside. In the meantime, build strong foundation by creating some 10 big corporates who can invest anywhere. I think we are in that stage. And market cap to GDP in India is very high right now. And these large corporates can invest in India right now. Right. And they have big money with them. So create opportunity by keeping the consumption alive in the economy, and protect the domestic industries by giving them, there should be enough competition, but also protect the domestic industries so that they can participate in India growth story, not get impacted. Like I was explaining with power sector, right? There was a domestic demand, but most of it was being met by Chinese import. You completely killed the domestic industry. So we should avoid such things going forward. So these are certain, if we get this policy initiatives right, and we move in the right direction, then I think globally, I don't think any other country can talk about a 6% real GDP and a 10% nominal GDP growth rate for 10 years on the go. Okay. If that is the case, 10% nominal GDP is possible for next 10 years. Equities, if you are a very reasonable fund manager or a reasonable investor, you can easily expect a 15% CAGR return. A 15% CAGR return next 10 years, we are talking about whatever money you have today, you are going to make it 4 times of that money in 10 years. So I think that keeps us very motivated about being in this role, as well as asking investors to stay invested in India.
Very interesting. I like that approach.
Yes.
So before I wrap up, I just want to ask you, sharing is caring, they say, for the benefit our listeners. Could you recommend a book? You already mentioned Naval Ravikant's book, but I want one more. So, or a show, or a movie, or anything which...
Sure. Where I spent time recently in the last 1 year, out of which I really enjoyed reading this book of Chips War by Chris Miller. I think it's a book where not just about semiconductor industry, but also you will understand how human being, science is evolving for human beings, and how it is taking us to a different level with the help of AI, how we are getting into a different zone altogether. And the benefits of it we will see in the next decade. But I think the book gives you a good understanding of the sector, first of all, and the work that was done by the author is amazing. He would have challenged any top tier global MNC brokerage and their ability to understand the sector, and simultaneously linking it to the political scenarios that played out in the last 50-60 years in the world, and also put in perspective like what India's ambition should be in the semiconductor industry, and why there is this trade war that is going on. You will get a very good context of all this when you read that book. It will create a good framework for you to look at how, as an economy, we should aspire. and grow. So that is on the book of Chipswar, and I think Naval Ravikant's book of the Almanac. I think he has covered. He gives a different perspective of how you should look at life as an investor. How much charged up you should be,
Right.
how you should aspire to grow, how much you should read, how much you have to invest on personal life as well as on the on the markets, as well as on how to identify, use your core strength. He is actually a science background. I think he's an engineer. He used his engineering capabilities to make money, knowledge in the engineering space to make money initially, and then become a very successful venture capitalist, right? So I think these two books, I think, can be good. On the podcast side, I liked listening to this podcast of founders in the Spotify.
Okay.
One risk is this is about the autobiography of successful investors and successful entrepreneurs. One risk is you might not end up reading them, which is very important. But I think 1 hour, the show gives a very good glimpse of what ran through in the minds of these, and what from where to where these people have come. Particularly, there was one about the Hyundai chairman in Korea, and how he built the business. I think it's a very interesting podcast. So I would recommend to your viewers that listen to that, and that's a very good portion of the founders portion is very good in the Spotify.
Okay, great recommendations. Thanks, Madan. Once again, I thank you for sharing your thoughts with us. They were extremely insightful. We wish you good luck, and thank you very much.
Thanks, Ravi, and thanks for very insightful questions, and wish you best of luck.
Thank you. So to wrap up, investors who have a long-term horizon, seeking active management, and that helps in identifying opportunities with good research. Most often the strategies prioritize wealth creation over short-term fluctuations, right? Successful alternate investors have been rewarded with outstanding returns. That's what I've seen with Sundaram Alternates. Well, folks, I hope you enjoyed the episode of Gaining Conversations with Madanagopal Ramu. I know I did. We'll be back with the next installment of Gaining Conversations soon. Happy investing. Thank you.
Thank you.